This is Colin Cattell, and welcome back to another episode of Palisade Radio. Today we're doing a special edition, and we want to announce the launch of Palisade Research. That can be found at palisade-research.com. We're going to be putting out free research on a weekly basis, mainly focused on the precious metals sector. Of course, a huge contrarian opportunity right there that we have identified. On the line with us today is CJ Kim. CJ is working with Palisade. He came to us from Marin Katusa's KCR Fund and KC Research. CJ, thanks for joining us today.
Hi, Colin. Thanks for having me.
So you just put out a great article titled 5 Charts Showing Why Gold Stocks Have Never Been This Cheap. And I'm going to have you go through one by one each chart. We'll put them up on the screen here. You can also find this in written form at palisade-research.com. Before we get started, what's the premise here?
Well, the 5 charts show that gold stocks are at a historical low, and hopefully this means that we're at a bottom.
Okay, very good. So on the first chart, it's Bloomberg Commodity Index versus the S&P 500. What does this chart show?
So this chart shows that every time there was a significant divergence in the index price there will be a closing of the gap. So the divergence that we're seeing right now is unprecedented, and which means that either the S&P 500 will drop or commodities will rally, or both.
Right, so the divergence between the S&P 500 and the basket of commodities has spread to a historical gap right now, and that's something we talked about on the show last week. The next chart, chart number 2, tell us about that one, CJ.
So it's a chart that we've put out before, and when I first made it, the TSX Venture in the current bear market was at a 74% loss. So now we're at a 78% loss, which is almost the record drop that we saw during the 2008-2009 financial crisis. In my opinion, the strongest takeaway from this chart is just how long we've been in this current bear market, which is longer than all the bear markets combined so far.
And the TSX Venture is, of course, an exchange mainly made up, I think, around 75% by mining issuers, and so that 78% drop represents a lot of it, the fall that's occurred in these small exploration companies and mining companies. CJ, how did you go about picking these blue zones, which are bull markets, and the red zones, which are bear markets? This chart's never really been done before, and it's slightly subjective, of course, but I'd like to know how you got these red and blue zones.
So I agree with you. Defining the bull and bear markets were subjective. I defined a bear when the market reached its peak and declined at least 15%. And the duration of this 15% drop was at least a month. And that's the same as a bull. Once it hits a bottom, an increase by 15% over a span of at least a month.
Very good. So in terms of time, totally unprecedented, only 1% away from that awful crash that we had in 2008, which led to an incredible rally of 124% based on your chart. Let's move on to chart number 3. I've seen this done before by other groups in the past, but not recently. Can you tell us what this is? It takes the HUI index against the gold price.
Yeah, so it's definitely not a new ratio, but it shows how I guess a basket of gold companies trade relative to the price of gold. So what we're seeing is we've not seen gold companies trade this low since gold prices were around $250 an ounce, and the ratio right now is at a record low.
Right, so if we were to show the chart of just the HUI, it would be comparable to where we were at in, say, 2002, but when charted against the price of gold, we have hit record low territories here, and it could continue to drop further. On to chart number 4, and I just want to state, we talk about this chart a lot. It's from our friend Jordan over at thedailygold.com. What can you tell us about this chart?
This chart shows that in a couple of months, the current bear gold market that we're in will be the longest in the history of gold bear markets. So like the TSX Venture chart, we've been scraping along the bottom. Hopefully this means that we're truly at a bottom, and hopefully we'll see a recovery in the near future.
And for any of our listeners that haven't seen this chart, it's a little bit confusing at first because there's a lot of different lines, but the 2011 to present dark red line, which extends the lowest and almost the furthest, is where we're at today. The bear market that started in April 2011 and is still continuing. And against that, Jordan's gone ahead and charted several of the past bear markets as represented by the BGMI, or Barron's Gold Mining Index. And you can see past is not always prologue, but as a bear market's made up of time and price decline, we're at a very, very extreme, and one would expect it to not go on very much longer. Finally, CJ, I want to finish with chart number 5, which is a pretty exceptional looking chart. What does that chart show us?
So it's another chart depicting a ratio, this time comparing the S&P 500 and a basket of gold and silver companies. And it's just another way of showing that gold and silver companies have never been this cheap before.
Right, so the S&P 500 to the gold-silver sector ratio getting to an extreme point. CJ, I want to thank you for coming on and explaining these charts, and depending on, I think the feedback's going to be great from our audience, but we'll definitely have to get you back on and keep up the good work.
Thanks, Colin.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw material. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?